Hello everyone, I am Anubhav and I am one of the co-founders of PCN Capital, which is a portfolio management service investing in Indian listed small and mid-cap companies. Prior to starting PCN Capital in 2019, I have a decade of investing experience at Elevation Capital, which is one of India's leading private equity and venture capital fund. Leaving Elevation Capital to start up was a very big career decision for me. What helped me was my strong belief that investing early in outstanding companies run by honest and competent promoters can create outstanding wealth for shareholders. During my investment journey, I met several outstanding companies like Atul Limited, Ajanta Pharma, SRF, when all of these companies were trading at less than 1000 crore market cap. And over the next 7 8 years, I saw them grow their market cap to several billions of dollars and create outstanding wealth for their shareholders. I invested in some of these companies and built a successful track record at Elevation Capital. So I wanted to start up as an independent fund manager, and it was very natural for me to team up with Sonal, who is my ex-colleague at Elevation Capital. We started PCN Capital together in 2019.
Hi, my name is Sonal Minas and I am the second founder of PCN Capital. My investing journey started as a private equity investor. As I grew through the ranks of leading private equity funds in India, I realized that the whole private equity investing universe is fairly small and there were too many funds chasing too few good companies. What that essentially meant was that the terms of the deals were defined by the founder or were stacked against us. That essentially resulted into subpar returns by the whole private equity industry. We believe that if we use the same frameworks of diligence and the rigor that we use in private equity and put them in public equity, where the entry, the exit, and the valuation is defined by us, the returns could be brilliant. We started using this strategy in public equity since 2011. Both Anubhav and I have been investing in small and mid cap space since 2011. We've been compounding capital at 30% since then. On the back of this track record, in 2019, both Anubhav and I decided to set up our own fund.
I think the most important question any prospective client would have in his mind is that what differentiates PCN PMS from so many other PMSs out there. The first differentiation is, of course, our outstanding track record. Since our inception in September 2019, we have delivered a 36% IRR for our clients. We have comprehensively beaten all benchmark indices, whether it's a large cap index like Nifty 50, a broad market index like BSE 500, or the Nifty small cap 100 index. Also, we are among the top 10 percentile of PMSs based on our performance since our inception. Our second differentiation is that we apply the private equity style of investing even in public markets. As I mentioned earlier, that we have several years of investing experience at some of India's top private equity firms. Since our inception in the PMS, we have been applying the same private equity approach. We do a rigorous due diligence of promoters to check their integrity, drive, and motivation. And also, we do a thorough research and tracking of businesses before investing in them. Our third differentiation is that we take concentrated bets. Usually, we have only 15 to 20 positions in our portfolio at any given point of time. And also, we are patient long term investors. Our average holding period for any investment is typically 3 to 5 years, and our churn is very low. Just to give you an example, out of the 17 positions in which we invested for our first set of clients back in 2019, we are still holding and in fact investing in 7 positions for our new clients. Fourth, we don't follow the model portfolio kind of approach. Any new client that comes on board our PMS, we invest his or her corpus over a 6 to 9 months period of time. Most of the mutual fund or PMSs, what they do is that whenever a new client comes on board, they would invest his or her entire corpus on day one in the existing set of companies in which they are already invested. Fifth, as founders, Sonal and I have significant skin in the game. 90% of our net worth is invested in the PMS, and close to 10% of the overall corpus of the PMS has been invested by us and our close family members. Lastly, we pride ourselves on client communication. We are among the very few PMSs in India that provide a live access to the portfolio on a mobile app to all our clients, and we also email monthly memos. Moreover, during periods of drawdown, we are very proactive in reaching out to the clients, informing them to take advantage of the correction and top up their portfolios. Now I want to discuss two important factors on which any PMS return should be evaluated. The first is the return of the PMS delivered for clients joining the PMS at different points of time, and the second is risk minimization. As I mentioned earlier, our strategy has delivered an IRR of 36% since inception in September 2019. However, I also want to highlight is that our PMS has delivered 30% plus return for clients across different vintages of time. The second factor to evaluate PMS returns is risk minimization. This pertains to how any PMS strategy performs during phases of market correction. Any strategy can do well during a bull cycle, but the true mettle of any strategy is proven when it performs well during phases of market correction. Since our inception in 2019 September, there have been two phases when the market suffered deep corrections. The first is during March 2020 when the COVID pandemic broke out. During this month, the BSE 500 TRI index corrected by 29% during this single month. But our strategy corrected by only 17%, thus outperforming the market. The second phase was during December 2022 to March 2023. During this phase, the BSE 500 TRI index corrected by 10%, but our strategy remained flat during this period. The reason for outperformance during market correction is the kind of businesses that we invest in. The high quality businesses that we invest in typically outperform during phases of market correction.
So our investing framework can simplistically be summarized as we're looking for a good promoter who runs a good growing business and whose business is available to us at a good to reasonable price. It typically takes us an year to finish our complete work and diligence to identify and invest into a particular company. Explaining the first principle of our investment framework is that we use our private equity approach and the rigor involved in it to identify founders which are good, very high pedigree, clean, have had no issues of handling minority shareholders, to zero in into founders with whom we can stay invested for a period of 3 to 5 years. This essentially helps us prevent permanent loss of capital. The second pillar of our framework is to identify a good business which has strong growth prospects for the next 3 to 5 years. For this, we use our extensive founder, consultant, and affiliate network to establish a 3 to 5 year point of view on a particular business and on a particular sector. Our prior experience in private equity also helps us to establish a view on both the public as well as the private side of competitors on a particular sector and have a 360-degree rounded view on a particular sector when we are investing in it. The third pillar of our investing framework is valuation. Actually, it is the only driver which is in our control. We would like to believe that we are amongst the most conservative funds which are investing in public equity in India. We typically invest in businesses at the bottom 10 to 30 percentile valuation range. So the stellar return of our fund is an outcome of us applying our investment framework and identifying multi-baggers. Since inception, we have identified 6 multi-baggers which have delivered anywhere between 6 to 15x returns over the last 4.5 years. Some of the names of these multi-baggers are JB Chemical, TD Power, Birlasoft, FIEM, NGL Finechem, and Voltam. We will be taking you through some of these case examples to explain how we have applied our investment framework to identify these multi-baggers. So the first case study we're going to talk about is Voltamp Transformers. Voltamp is a transformer company which we've been tracking since 2013. It is run and managed by one of the most conservative founders that we've encountered on the listed side. They're extremely efficient to manage their balance sheet and run their operations. There are two key recipes to identifying a multi-bagger. The first is strong earning growth and the second is multiple re-rating. Both apply in case of Voltamp. Voltamp has delivered a 37% earnings CAGR during our investment horizon. We entered Voltamp at a trailing PE multiple of 13 times and we continue to hold Voltamp at a current PE multiple of 30x. We have generated a return of close to 13 to 14x in Voltamp.
The other multi-bagger investment of our PMS that I'm going to discuss is TD Power. TD Power is a small cap capital goods company that makes generators. We have been invested in TD Power since our inception in 2019 and it has generated 13x plus return for us and we are still invested in the company. We invested in TD Power because its promoter has delivered the best execution in the capital goods space in the past decade. During the past decade of 2010 to 20, capital goods sector went through a severe downturn in India. But during that bad phase, the promoter did both market and product diversification, and all those diversification has helped the company deliver strong growth since 2020. TD Power has delivered both multiple re-rating and strong earnings growth for us. When we invested in the company, it was trading at a P/E of 17x, and today it is trading at a P/E of 38x. In terms of earnings growth, it has delivered a 21% CAGR during our investment horizon. If you want to invest with us or are interested to know more about us, please feel free to contact us. Our contact details are shown on the screen.